Hi everyone, it's Jack back with another video. Today I'm going to be talking about Meta Platforms, formerly known as Facebook. Stock has had a really rough 6 months, down in the wider downturn, and then the stock has took a beating on earnings, down nearly 30% in a day, has continued to decline a little bit, down 42% from its September 2021 highs. Stock has lost the S&P 500 in the last year, down 20% over the previous 12 months. I just want to figure out, is it oversold and is it undervalued at these prices, and crucially, is it a buy? First thing I want to look at before I look at any financial reports is the balance sheet, then some valuations, and then a DCF. So as of right now, Facebook has $47 billion in cash on the balance sheet and around $13.8 billion in debt. At the end of 2020, cash on the balance sheet sat at nearly $62 billion, so there's a significant decline, a significant increase in spending, so this cash to debt ratio is going to get squeezed and will definitely be trending downwards. Right now, the cash to debt position is reasonable at 3.46. Equity to assets, again, also reasonable at 0.75. Not great for Meta's history, but just reasonable versus the wider market. Debt to equity and debt to EBITDA are both very low at 0.11 and 0.25 respectively, indicating Facebook's debt position is actually pretty well covered. The company has been assigned an Altman score of 11.29, indicating the company is not in immediate risk of financial distress and not an immediate risk of financial default. So as far as I'm concerned, these metrics are okay as long as they don't continue to trend downwards significantly. And part of the reason why I'm okay with this is because Facebook has allowed a lot of leeway because of its tremendous profitability margins. Profitability metrics for Meta are absolutely excellent. Operating margin 39.65%, net margin of 33.38% are both absolutely fantastic, and again will provide the stock a lot of leeway. Meta takes home 33 cents for every dollar of revenue, which is really strong. Return on equity of just shy of 30% is again outstanding, some of the best you'll have seen for Meta's history. Return on assets of, 23.74, again, absolutely excellent. I would expect this to be around 15%, and I will be impressed with that. 23.74 is excellent. Again, with return on equity, I would have been impressed with around 15, maybe 20%. 30% is absolutely excellent, especially for a company at Facebook's scale. So overall, financial strength and balance sheet, just okay. Profitability metrics, outstanding. Really, some of the best you'll see for any company. Next up is valuation. Again, there's a lot of ratios, a lot of metrics here. I don't look at all of them. The principal one I'm looking at here is the price to earnings ratio. P of 15.91 and a forward P of 15.21. Pretty much the lowest valuation in Facebook's time on the public market. Far below the S&P 500 average of I think around 22 at this point. Indicates Facebook is being valued like a slow growth, mature business with weak outlook. And this is absolutely not the case. PEG ratio of 0.6 where 1 would be a favourable number, indicates that Facebook stock is significantly discounted compared with analyst expectations of earnings growth. Other metrics are also really strong. Price to free cash flow of around 16. If you look at the right hand side, these are all exceptionally strong metrics versus Meta's historical valuations, and a valuation rank of 10 on Guru Focus, which I don't think I've ever seen before. Of course, that doesn't really mean much. What I'm looking at is the numbers, and this is a very cheap valuation on the surface for Meta Platforms. Next on the list is working out an intrinsic valuation using a discounted cash flow analysis to work out a fair value and with a good margin of safety, a fair value that I'd be willing to pay for Meta Platforms. So I've done this on both an earnings per share and a free cash flow basis. They're basically the same numbers. Earnings per share and free cash flow are a couple of cents apart on the quarter. So for the interest of posterity, I've just used earnings per share for this because they are effectively the same. So looking at these numbers, I've decided to use a 10% growth rate on the left and a 20% growth rate on the right. These are both absolutely conservative numbers, particularly on the left, more ambitious on the right, but these are conservative numbers versus Meta Platforms' 10, 5 and 1 year annual earnings per share growth rates of 68.5%, 27.8% and 36.5% respectively. Now, do I think its earnings per share is going to grow at 68% for the next 10 years? Obviously not. That would give it an absolutely ridiculous earnings per share number in 10 years time. But is 10% possible? Absolutely. Is 20% possible? Absolutely. I think 10% is very conservative, but I just wanted to do this because of the wider problems in the market at the minute. I've used a discount rate of 9% for the long-term returns of the stock market, and these gave fair values of $263 for the 10% growth rate and $524 for the 20% growth rate. Now, these are both significant discounts to the current stock price. Current stock price is $219, so you get about a 20% margin of safety on the left-hand side calculation, and roughly 100% upside on the right-hand side valuation. So as you can see here, Facebook is tremendously undervalued, even going conservative at 10% earnings per share growth rate over the next 10 years. And if you want to be more ambitious or you're particularly bullish on Meta Platforms, stock performance, then you're looking at tremendous undervaluation compared on the intrinsic value of the stock. Revenue for Facebook is of course slowing. Revenue growth wasn't going to last forever, but in the last 2 years or so, it's still been really strong. Continues to grow at a strong rate in every geography. Growth is not blowing the doors off numbers, but a healthy 20% of these scales is very impressive. And when the current margins of the business, this is absolutely fantastic and is all Facebook really needs. Looking at the right-hand side, you can see US and Canada still really strong, $15 billion just for the quarter. Europe is the next largest market, 8.17 billion, and then Asia and the rest of the world. There's still a lot of growth to be had here in terms of average revenue per user growth. So let's be frank here, Facebook is no longer the hyper-growth stock that it once was. User growth is obviously not what it once was. Facebook is essentially at scale now, so we're not expecting blow the doors off user growth. We're expecting them to maintain, to not go down basically, and they're succeeding at that. The Facebook family of apps, i.e. Facebook, Instagram, WhatsApp, now attracts 2.82 billion users. Despite the competition from the likes of TikTok, there's still been no decline for a while. Very impressive numbers. This is like, 40% of the world's population are using one of the Facebook main three apps on a regular basis. Absolutely tremendous. From quarter 4 2019, 2.26 billion to now quarter 4 2021, 2.82 billion. This is absolutely fantastic. Really strong engagement, and still in raw numbers growth, that's like twice Snapchat's daily active users in 2 years. Absolutely incredible. Zooming out and looking at the family monthly active people numbers, 2.89 billion in quarter 4 2019 to the present day, 3.59 billion. Again, no declines really, and we're looking at fantastic numbers. That's a 700 million people growth in 2 years at this type of scale. Absolutely excellent. We're not expecting blow the doors off numbers here. We're expecting Facebook to maintain and not decline, but consider the level of competition. Adding 700 million monthly active users is absolutely tremendous, and again, that's like double Snapchat's users in 2 years at this sort of scale. Absolutely tremendous. Important metric with any social media website is average revenue per user, which Facebook call family average revenue per person. In quarter 4 2019, $7.38 to quarter 4 2021, $9.39. Really strong growth over the longer term. This graph is a bit all over the place because average revenue per user is not a linear thing. It has a degree of seasonality, but these are really strong numbers. And importantly, this includes the family of three apps. WhatsApp is very poorly monetized, and Instagram is nowhere near as well monetized as Facebook. So there's a lot of room for this average revenue per user growth number to jump up if they can monetize WhatsApp effectively, particularly, which is a great challenge for the business, I know. But monetizing Instagram shouldn't be that difficult to get it towards the level of Facebook, and there's a lot of growth runway here in my opinion. You may be asking yourself, looking at the slides, why the stock has such a hit. That's of course because the Q4 report was very, very weak. Comparing to the previous quarter last year, just 20% year-over-year growth compared to the full year growth of 37% for the company. This is a very weak quarter. Costs and expenses up for the quarter, 38% year-over-year growth compared to 34% for the full year. Income from operations was actually down 1% compared to 43% for the overall growth of the company. Net income down 8% compared to 35%, and diluted earnings per share down 5% compared to 36%. This is very weak and there's no getting around that. And if this was a long-term trend, I would very much understand a 40% drop, but it's not a long-term trend at the minute. And even then, 20% revenue growth is pretty strong. And for a company that was trading at a PE of around 25, that is reasonable for me. Not every company on the S&P is growing its revenue at 20% year over year with 35% operating margin, 37% operating margin. So I feel like Facebook was unnecessarily dinged just because it's going through a lot of the minute. It's changed its name to Meta Platforms. It's kind of a stock that everyone loves to hate. And I think this is just like an absolutely unnecessary oversell for admittedly like numbers that are coming down, but they're not. It's not a precipitous drop. These are really strong results for the year over year. And overall, the company, this is one bad quarter. I don't think a company should sell off effectively 40% for one bad quarter. It's not as if this quarter is completely disastrous. Another problem some people may have with the company is that Meta is spending a lot more money in CapEx. CapEx for 2020 was 15.7 billion. Now it's 19.2 billion for 2021. This is predicted to only increase. This is basically because the money they're spending on metaverse investment, on data centers, on all this type of things, investments for the metaverse, because that is what the company is moving towards. They see this as the next generation of the internet. And more power to them. I believe that if they can pull this off, and if the metaverse actually comes to fruition in some way and people use it on a daily basis, this will be an absolutely incredible investment. But do I think that's actually going to happen? I mean, who knows? I don't know right now. It's very much pie in the sky. I'm not sure if people actually want the metaverse. The majority of people would actually use it. But Mark Zuckerberg in particular, this is a real pet project for him, and they're going to increase spending money at an increased rate for the foreseeable future, and hopefully it'll pan out for them. Who knows? Again, I'm not so much of a fan of uncertainty in stock investments for this. With Facebook's profitability profile, I think they can afford to spend some money. We see with Google, which also has an excellent profitability profile, that they waste in inverted commas so much money every year on the other bet segment, and people seem to give them a free pass. I'm not really sure why Facebook is getting beat down so badly for spending a bit of money on the metaverse and for having one bad quarter of revenue growth. So in summary, the choice here really is, do you think this is the start of a decline, or do you think this is one bad quarter of revenue? And truth be told, I think it's kind of a bit of both. I don't think we're going to be seeing like high 30s, 40% revenue growth for Facebook forever, or Meta Platforms forever, sorry. Do I think this is part of a wider decline to zero? Of course not. I think Facebook will continue to grow, Instagram will continue to grow, WhatsApp, there's a lot of potential for monetization there, and they also have a tremendous amount of metaverse investments. There is revenue to be had here. Average revenue per user can go up dramatically if they manage to monetize, particularly WhatsApp, but if they manage to continue to monetize all three effectively, then there's space for average revenue per user growth. User growth is not declining, so 1 quarter of weak revenue growth doesn't concern me too much. If it happens and continues to happen, then I'll be concerned. But to be honest, I think this is completely priced in. I think there's significant margin of safety with the stock here. Even at 10% earnings per share growth for the future, I calculated a fair value that was 20% below the stock price today. With more ambitious growth numbers of 20% for the next 10 years, then this is a company that has more than 100% upside. So for me, there's a lot of margin of safety here, and I'm very much considering buying this stock at the current prices. I'm going to wait for it to calm down a bit because I think the price action is just a bit ridiculous at the minute. And who knows where it's going to go. So I'm happy to leave a couple of dollars on the table to have a less volatile stock and be able to sleep at night more. But I think this presents an interesting buying opportunity for the company. Just $220. It's what, 15 forward price to earnings, PEG ratio of 0.6, discount far below fair value from my calculations, even the conservative ones. I think this is a reasonable buying opportunity. But of course, you should do your own research. Now, this is financial advice. If you want financial advice, you should talk to a registered financial advisor. And with that, that's the end of the video. If you enjoyed the video, could you please like and subscribe to help the channel grow? Thanks.